Hello, everyone, and welcome to another edition of our Udemy Mastermind podcast. Today, of course, we have Simon on and me. My name is Dan Rue. I'm a real estate investing consultant specializing in mobile home parks. And today's a big day where we review the answer to the case study that Simon has posted earlier. And of course, let me bring Simon on. You guys all know Simon.
Hey, good morning, everyone.
All right, yeah, welcome, Simon. I was about to introduce you and tell everyone about all the great things about you, but I think at this point they probably already know, which is why they joined the group. So how's everything going, Simon?
Great, actually. I recently got engaged.
Yes,
So
congratulations.
very happy about that.
Yeah.
Totally surprised her. She had no idea it was coming. I got a lot of people to help me make her think it was later. Throw her off a little
Now I
bit.
know I have some insider information here that there was sort of a process involved in doing this engagement. Is that something you're going to be sharing with the group later on in the future?
You know what? Yeah, I actually I'm putting together a video that kind of uh, captures the whole process of
Mm-hmm.
how I proposed.
Mm-hmm.
I'm told it's pretty unique
Mm-hmm.
way of proposing, so
Right.
I'll share that next week
Right. So,
for those that are interested.
yeah, for everyone
So
who joined this group to learn about investing in real estate, stay tuned for Simon's advice on how to get engaged. Well, the good thing is it works, so we know it's good advice.
I have a 100% track record.
That's true. And speaking of 100% track records, you might not always have that in real estate. What do you think about that transition?
Yep.
But you'll definitely increase your chances if you know how to analyze deals as well as Simon does. So today, in today's episode, Simon, you're going to be reviewing the case study that you presented to everyone. And you know what? I'm just going to turn it over to you. Maybe you can spend a few seconds telling everyone like the basics about what the case study involved, and then yeah, walk us through the answer. And if I have any questions, I'll jump in with some questions along the way.
Sure, sure. So, all right, let's get started. Now, uh, before I get into the details of this, I still want to just kind of refresh people about this case study that we're looking at.
Yeah.
It's purposely simplified a little bit so that we're really evaluating a single situation, trying to answer a single question,
Right.
right? We're acquiring a multi-tenant office where one of the tenants that makes up the bulk of the square footage,
Mm-hmm.
the tenant number two that's highlighted, has rents that's pegged to CPI or the rent bumps. So the annual bumps, how much the rents that are collected are increased from the prior year, is variable. It's
Mm-hmm.
not fixed like the other leases. And this can happen, especially if for kind of anchor or large tenants. They a lot of times they have more negotiating power.
Right.
They say no, we're not going to do 5% bumps.
Right.
We're going to do something smaller. And what you see is the more leverage they have, what I would expect also sometimes to happen is may say, hey, we're going to peg it at CPI, but it's going to be capped at
Right.
this percentage, right?
Right,
They
and
usually get their
just to
favor.
back up one step, CPI, we're talking about the inflation index, the consumer
Yep.
price index, and that sort of pegged and lets us know how much prices are going up. I think most people know that in this group, but just
Yeah.
to sort of clarify that.
Yeah.
And would you say this might also be something you might see in a rent-controlled apartment where they're only allowed by law to raise the rents according to
Yes,
CPI?
yes, but that would not be something that would be kind of negotiated by any of the tenants, right? That would be
Right.
more coming from the local regulation.
Right, right, right.
Yeah.
Okay.
So a recap from last time, we kind of talked about the process, right? And then so I'm going to recap kind of how I, in terms of a framework, approach modeling real estate solutions.
Right.
So the first step was to think about what is not there in terms of the information, right? We were given pretty much this information, but one of the things that we weren't given was, and I purposely didn't give it to you, was some additional information such as what the interest rates were,
Mm-hmm.
and if you were selling it at what was the cap rate that you're selling it at,
Mm-hmm.
and you the loan. Let me see. Also what else? I think that was it. So there's a few
I think
things
there was
that.
a few people were asking about like when they sold. They wanted to
Oh,
make sure that
yes, yes, yes.
happened at the end of the
Yeah,
years, not the middle of the year. And also, I think the
yeah,
purchase date. The people wanted to know that. And just a real quick recap: the question involved in all this is given this set of leases, given the set of how much you put in and how much money you paid for these properties and how much they're paying in terms of monthly rent, what would the returns be like, the IRR, the yields, cash multiples, and how would they vary according to the different CPI scenarios for the tenant number two, which if you took Simon's course, I'm sure everyone's sort of familiar with the IRR yields and cash multiples. Basically, you're saying, how does this thing perform, right?
yeah,
In other words, that's the
yeah,
central question, right?
yeah. And a lot of times, for when you're analyzing a particular investment opportunity, you're not really trying to. You're almost never trying to. Basically, you're never trying to get to what is the right return that you're going to get. There's no
Right.
way you're going to have that kind of accuracy. You're really looking at, well, what if this scenario
Mm-hmm.
versus that scenario versus another scenario,
Right.
likely scenarios, right? So you're kind of usually looking at several different outcomes or ranges of outcomes.
Mm-hmm.
Yeah. So once you look at the question, what you need to answer, and then
Mm-hmm.
decide what's not there, you can make some notes about what you might have to research or find for yourself.
Right.
When you're looking at deals out there, oftentimes they're not going to put it nicely packaged for you, the information. Especially you're looking at like kind of your one-off deals on your own.
Oh man.
Unless you're doing something for an institutional investor, you're
Yeah.
working at a big fund,
Yeah.
then brokers and other folks will be approaching you all the time with
Yeah.
pitch decks for their deals.
Just real quick on that, because I get deals through real estate brokers. I get them through very professional real estate brokers. I get them through smaller brokers. I also get deals directly from the owner. And yeah, the presentation of the information can vary wildly from a very professional OM offering memorandum or package or whatever
Mhm.
to I think I have about 20 units. I'm not exactly sure, and most of them are paying 175. But so I think a lot of my time sometimes is just looking through all that information and trying to piece it together into something pretty like what you have on the screen.
Yeah, and that's one of the things that folks don't realize. Modeling the solution out is just one part of the analysis. Um, Having confidence that the inputs that you're putting in
Hmm.
are accurate
Yeah.
and actually reflect the situation or the project you're looking at, that's a whole big part of it. That's really
Yes.
important because
Yes.
basically, if you put garbage in, you're going to have garbage out.
Garbage in, garbage out. Right.
Yeah.
Yep.
Now, cool. So once you have what's not there, then what you want to do is think about the end, right?
Yep.
So I'm going to take you all the way. I always start with, I just create, what do I want to see as a result
Oh,
from
right.
this
Okay.
analysis?
Yeah. So
So
there's your solutions right there.
yeah,
Hmm.
so I want to, I basically just put a structure, and sometimes I'll just put like dummy numbers in here just to, no, this one's completed, but when I start off, I just
Right.
put some dummy numbers there just so I know what I'm trying to get to.
Hmm.
Um, so in this part, well, I'm trying to see what the returns are, right? Both
Hmm.
IRR and cash multiples. I didn't do the yield one here. I'll
Yeah.
add that later. Now, what the low, middle, and high cases are.
Hmm.
So once I have that, I know I can answer the question. So then what you want to do is then you go all the way back to the top, and you got to look at your timing. So that's where you model out the timing of so when the purchase might be, and then do you do it by year or by month, right? In this
Hmm.
case, we're kind of doing this is more or less a back of the envelope
Hmm.
style analysis. So I'm just going to look at it by year. We're
Okay.
not trying to be super accurate. We want to
Hmm.
get a sense, a feel for how the scenarios compare to each other.
Right.
Um, and so here, what I did was then, all right, well, I'll put the dates by year,
Hmm.
starting from the purchase, and then just add a year to each. And now there's a formula that in Excel where once you have a starting date,
Yep.
have a starting date at 1/1. Then to easily just add a year to it, you just this formula called eDate.
Okay, good.
eDate, and then you go put the previous the date input, and then the next input is how many months you want to increment it.
All right.
So
I'm gonna write that formula down and put it in the chat thing so people can see that. Okay, eDate. I didn't even know about that. Okay.
Yeah, and so if you're running a monthly thing, then you just put 1. So then you don't have to worry about how many days have, like is it 30 days or
okay.
it just does by month.
Right.
Yeah.
So the second variable is the number of months, basically. Yeah.
And so drag that formula across, and I get it to, let's say it's selling it in 10 years.
Yep.
So let me just do the count. So you'll notice that 10 years will end at the 10th year starts on 2015, but really ends like at the end of that year. So I'm just gonna make an assumption that I'm selling it on January 1st, the very first day of the 11th year, which means it's like you got 10 years there, right? So that's one thing to sometimes be careful about, is if you do assume start the ending or the end or start of the year, that you make sure you don't leave out a full year or add an extra full year. So if I sold at the end of 2016, then I'm actually looking at it as 11 years.
Right. Okay.
So now, once you have timing, and the other part of timing is you also want to make a note of things that are happening. So like when our lease is getting renewed, for instance, if it changes. So in this case, we're assuming that it renews at the same terms. So there's really not much to do in the modeling, but I just make a note of it here, right? In that year. Let's see. All right. So that's it for timing. Then the next thing is we want to look at the big assumptions. What are the big assumptions that will impact this analysis? Okay.
Well, hang on one second. I'm sorry. I thought I understood something, but it says lease renewal 1/1/23. What's that notation in reference to? Is there a note here about something happening on that year?
Oh, yeah. So basically, that's when the leases renew. But because they're renewing at the same terms, we're assuming that they're renewing at the same terms. I can just make the assumptions about the leases for each of them continue the same or increment the same way.
Okay.
So I know that when it renews, these rent bumps are not going from 3 to 5%, and that the base rent or whatever, it's not changing, right?
Is there a reason why it's written in column J, the word lease renewal, or is that just in the middle somewhere?
Oh! You know what? I missed. Hold on. Where's? I thought that was it renewed. Oh yeah. Because so lease ends, right?
Okay. Yeah. There you go.
All right. Actually, I wrote it in the wrong year. Yeah.
Okay. Yep. Got it.
I wrote it in the wrong. So it is in here.
Yeah.
So,
okay. Perfect.
Yeah. So I'll call it LN, and then it's for tenant 3. So that's a good catch.
Yep.
Yeah, and then the other one is LN tenant 1, and then this will be LN tenant 2.
Okay, perfect.
Yeah, good catch. So then once you have the timing, now right now there's that's just for us to remember, but not for us to make any changes.
Right, it doesn't affect anything,
the implementation.
Right?
Yeah, exactly. But when you're actually doing analysis, most of the time for lease renewals, there's some negotiation, or unless the option and the option for renewal sometimes will be a renewal at different terms. Usually it's at the same terms, but sometimes it might be at different terms.
Right. Okay.
So you have to actually look at that. But once you have that, then you want to look at your big assumptions, right? So one of the big assumptions that we're testing is, the low, middle, and high cases for CPI.
Right.
And I think
low got erased, right? I mean, it's up there
somewhere.
Yeah,
it's just it's hiding.
Yeah, okay, yeah.
Where's my? Yeah, it's hiding there. But the low is like
0.5.
0.5. Okay. So what you do is then, all right, well, let's set the let's set the CPI, the assumptions, and we're assuming they're going to be constant here all the way through, right? You know, if that's an easy assumption, but you know, there could be a scenario where you pull data from some economic research group that says, hey, over the next 10 years, here's a low case or middle or high case, and you know, they may have different numbers where they may it starts slower and ramps up versus, you know, something opposite, and then the other scenarios just ramps at a different rate. Right. So you might get like an actual CPI schedule. Right. But in this case, we'll just assume that they're the same throughout.
So we're keeping it 0.5, 0.5, 0.5 just to make it easy. But in reality, it could go 0.4, 0.5, 0.3, 0.6 or something and have some sort of funky thing going on. Okay. Yeah. And these are all just predictions anyway. So
yeah, those are predictions. But you might see something where from multiple research groups, they all of them expect inflation to go up, but they disagree about how quickly and how much they go up.
Okay. Right? Yeah. So the slope may vary. Yep.
Yeah. Okay. Exactly. Then once we have that, the other big assumptions are going to be around the tenants, so the rent bumps, right? So we're going to look at what are their rent bumps for each of the tenants. So for the tenant 1 and 3, their rent bumps are pretty straightforward. They're 3% a year. So the way you want to model out rent bumps is because and because we're going to use it to change the actual rent collected from the base rents. What we're going to do is then you say, well, in year 1, it starts at 100% of the base rent.
100%, yeah.
Yeah, and then the following year, it increases at the rent bump. So for tenant 1 and 3, what I have in the formula is I go previous times 103%. Now this right here is not something that you normally do for this is not good practice. Okay? I leave it here just so I can talk about it. You see, here's a what's called a hard-coded variable. Right. 1.3. That's not good practice because if you want to change the rent bump later, you're like, oh, you know what? It's not 3%, it's 5%. I change it there. It doesn't change anything. Right? So what you want to do instead is you want to do something like this. It goes 1 plus and want to fix that so that if I change that variable later, it always changes. Now, but I want to make sure this formula is, I want to make sure this formula is, all the way to the end. Okay. And so now, look, if I change this variable here now, pay attention to this part, row 34. When I change this to something, it automatically changes now. Right.
Okay, let's take a look at that formula again. So it's D34, which is 100%. So that's our baseline. We're starting at 100%. And we're multiplying it by 1 plus the annual bump. So
for that respective tenant. Yeah.
And for each cell, as you go forward, it's just basically taking the cell right next to it, the one right to the left of it. And since that's already gone up, then it just goes up by that annual bump increase. And that's why, in case anyone's wondering, you don't need to put the actual compounded interest formula and put in the time or anything like that, because you're just basically referencing the cell right next to it every time. And that cell has already put in that increase in there. So okay.
And the other thing is you'll notice that there's 2 references, right? The reference to the cell before, I don't have any dollar signs in front of the letter or the number, and because that means it's a relative reference. I want the one right next to the immediate left. But the reference to the number for the rent bump here, it has the $2 signs. It means it's absolute reference. It's always referring to that no matter where the formula is. And that allows me to go from, here, anywhere here, and then you'll see that, hey, this is still referring to that rent bump, but now it's referring to the cell to the left.
Right. Otherwise, it would refer to column J up on line 6, and then column K and all that other stuff, and then you'd get weird data.
Yeah.
I'm sure everyone knows absolute references, but just as a
Yep. So now I want to do the same with the tenant number 3 as well. And then so basically you can just copy and paste the formulas. Okay, so now they're there. But I'm going to put this back to 3% because that's what the assumptions are.
Yep.
Okay. So now the trickier part for the tenant to handle is tenant 2, right?
Right.
Because, well, the rent bumps, there's 3 scenarios. So what do? We set up 3 scenarios for the tenant 2, okay?
Yep.
And just a quick note. I have this here, just square footage, percentage of square footage. It's just something that if I'm sharing this with other people, they can see that tenant 2 is responsible for 78% of the footage. It's just as a reference. Yeah.
Yeah. Okay. So basically 78 plus 12 plus 10 equals 100.
Yeah.
So that's 100% of the square footage that you're renting out. Okay, great.
Yeah.
Okay.
Yeah. Whoops. Now, I just saw a little mistake here. This happens actually. It's very easy. Do you notice it, Dan?
No, I feel like I'm on the spot here. No, I don't. What happened? What did you do wrong?
So you see the year starting here, but there's no numbers here. It's not. No, you don't see it yet?
No, not yet.
Okay.
So.
Okay, so basically, I don't have the entire first year, the 2016 year, in terms of rent bump assumptions. So I'm kind of staggering it a little bit later.
Oh, okay. Because you're
Does it make sense?
Yeah, you're not starting with the 16th because we're supposed to have bought it on the first day of the 16th, not the first day of the 17th. Oh, okay, okay.
So this one's so the way I'm going to fix it, which is really easy because we're using the e-date formula.
Yeah.
I can just shift everything over.
Right.
By because I already now let me see 19, 20, 22.
Yep.
And then now the sale is actually the one after.
Right.
Oh, you know what? I had these frozen, so it's a little bit harder for me to make that adjustment.
Right.
Hold on, let me just go here.
Mm-hmm. Fun with Excel, everyone.
Yeah, you know what? That's one of the things is, and I've been doing this for a long time, but you can still make silly mistakes, right?
Right. But the good thing is, since you set it up a certain way and you're using the right setup, you're not hard coding everything. It's pretty easy to make these changes.
Yeah, exactly.
So you don't have to go in and manually change every cell. I admit I'm somewhat guilty of hard coding a little too much when I'm trying to get things done fast. But and then when I have to go back and change things, it's just a pain. So it's definitely good practice to do it the right way the first time.
Right.
Okay, so now you're shifting everything over just to make sure everything's consistent, right?
Yeah, actually, you know what? That's funny. So I thought I did.
I thought you were wrong, but you were actually right.
Yeah. That's funny. Yeah. So here's the thing with labeling. The dates. Sometimes what I'll do is just to make it more clear for myself, I'll name this is kind of like purchase.
Okay.
And then this is year one, year
end of year
2.
One, basically.
Yeah. I'm kind of accumulating it.
Yeah.
So that's one thing. That's why figuring out your timing is really important because it's
right.
It's easy. Yeah, there we go. Year 10. All right.
Okay. So you had it right. You had it labeled.
I didn't
wrong.
label it, and I confused myself again.
Okay. So that's
Hey, it's early morning. I'm on a high dose of what is this? There's the Tylenol hydrocodone.
And that's not something you do regularly,
no,
right?
That's
right?
I do regularly.
You might want to explain that.
I had a surgery yesterday.
Yes.
I had a surgery yesterday on my shoulder, and it was brutal waking up this morning.
Yeah, we have a wounded analyst on the call right now, or on the podcast right now. So give him a break. He's on drugs.
So all right. So then we have Tenant 3 again. We start at the year 1, and let me see. What I'm gonna do is I'm gonna refreeze the different frames so we can always have the years as reference.
Right.
So I'm gonna unfreeze that, and then I'm gonna. Oops.
And just for people who are watching and kind of wondering like how you're manipulating the spreadsheet, these are all things that people can pick up and can learn. And if you have any questions about how he's doing this stuff, just ask him in the Facebook group. I'm sure someone else in the group can answer, or Symon and I can jump in as well.
So, I'm just trying to make it easier for you guys to see. But one of the tools that's very useful to use is called freezing panes. It's under layout, and then you'll see that. And what I'm doing, basically, you select a cell, and then if I freeze panes from there, it'll freeze things both on a row. So if I scroll down, it locks it. And now every time I go down, I can see what year it's related to.
Right. Yeah, that makes it real convenient.
Yeah. And I'm just going to make it a little bit smaller so everybody can see everything. Oops, it's too much. Just condensing it a little bit so we can see kind of the whole thing, and I don't have to keep scrolling to the right to Okay. So there we go. So now we have all of it, right? But then now I can always reference the year as we go down in the analysis. Okay. So now for tenant 2, again, in year 1, it's 100% of the rent, which is the full base rent right there, right?
Yep.
But then the increases are going to be different depending on the scenario. So what we're doing is we're doing low, middle, high.
Right.
And then I'm referencing the cells up here. So if you see for tenant 2, it's referencing the second one for for scenario 3, it'll be referencing the 4.5.
Right.
Yeah.
Right.
So same formulas going across, but you get to see that they're different now, right?
Yeah.
By doing it like this, you'll get an idea of what's next to come, where when we look at the cash flows in. So, all right. So cash flows in, okay, so is going to be the rents.
Right.
Okay. And this one, let's see. This one will be so year 1, and you'll notice that the numbers look kind of small.
Right.
So I don't know.
$52, is that all?
Yep. So a lot of times, especially if you're doing deals where they're like in the 7, 8, or 9 figures, sometimes you're not analyzing those.
I hate when I'm doing those deals.
It looks. Yeah, no. If you have all the regular numbers, it fills up. It makes it really wide, and you see less of the screen.
Yeah.
So what I do is I just, I'm gonna just do everything in thousands.
Right.
Okay. So that's what I'm doing here. The first year is just I'm taking the baseline rent, right, and I'm multiplying it by the rent bump,
right,
which is the first year is 100%,
right,
and then I'm dividing it by 1,000.
Right.
So then if you look at that, for each tenant, I'm referring to, you see that tenant 1 is referring to the rent bump here, and then it's referring to the same base rent. So we're bumping it throughout the 10 years base, starting with the base rent. But because all these rent bumps are cumulative because it's bumping from the prior year, we know that it will have the correct rent figure.
Right.
And so we do that for tenant 3, and then we also do that for tenant 2, which is from the other scenarios here, right? So you make sure they all match up. And then what we see then is we see that the rents coming in, we're going to have it going up. It should be increasing. Right. So that's how you kind of do a sanity check as well. If you eyeball it and it's not increasing, you're expecting 3 to 5% rent bumps, and it's not increasing, there's something wrong with your formula or setup there.
Right. And also this explains why you wrote it out at the top. When you're writing out the percentage increases, you're going 100, 103%, 106%, 109%, 113%. It's so that later on, when you're trying to calculate the actual cash flows, you can just reference the cells in a very clean way. And I know that again with the setup, you want to set it up where it's all consistent across the board, so it's easier to kind of check your code later on and check your formulas later on.
Yeah. I'm just gonna delete some extra rows that are unneeded. Okay, now
because you could have, you might have been able to put like a messy formula in there, like the annual rent bump times 1, and then put the year or something like that, and you could have had it all kind of condensed into one thing. But by doing it this way, it's very clean. It's a very easy way to kind of, I think it's avoiding too much complication in one cell in terms of a formula.
You want to make your formulas as simple as possible.
Yeah.
So the more you want to remove as many calculations or logic in the formula as possible. So you want each role to just have one logic,
step, right? Yeah. Okay.
So if you have multiple ones, you break them out through different steps. It's okay to have your models go deeper, but it becomes a lot more manageable and much more easy to follow.
Right.
Even not just for others, but even for yourself, you're looking at it a few weeks from now.
yeah, and that's the thing. Like, I'll put together, and I'm guilty of putting too much in one cell, and then I'll be like, oh, I'm done, and then I'll look at it, and I'm like, but how do I know if I'm right? And then I have to go back and look at each cell and like, okay, did I add this? Did I add that? And just seeing the way you lay it out here, it's just so much cleaner to just do it this way. That it makes it much easier to not only to figure out, but also to check later on. And I think that's something that we all sometimes feel a little bit worried about when we're putting together these assumptions. Like, did I make a mistake? Did I do it the right way?
Yeah, absolutely. And then once you have the rents, the only other cash flow in that we're going to have in this case is when during the exit.
Okay. And why did you put INS, by the way? What's that mean? I was like, insurance? What?
Oh, no. Sorry. So it's cash. It's cash in.
Okay.
Ins.
Okay. The ins, I got it.
Yeah.
Okay.
So that's another thing. Like, especially early on when you're just modeling out, and I wanted to stress actually that when you're doing it initially, you're doing it for yourself. You want to make sure you get the structure right. So make sure the labels are clear for you. Yeah. But then one of the last things you do is cleaning up all your labels, cleaning up the formatting, and making it pretty for presentation. You don't want to do that early on. You don't want to do that before you have everything else done, because it can change. So if you start formatting it out, making it all pretty and nice, and then you're like, oh man, my structure's all wrong, you got to do it again, then you're basically repeating that process.
Okay. Yeah. So no need to start color highlighting each cell yet.
Exactly. That's why for those of you that have seen like my models from the course, you see that this is very different, right? The models in the course, I have it very labeled very clearly which ones are the variables, which ones aren't, especially for the presentation worksheets.
Right. Yeah. And then you start changing the blue colors or the inputs and
yes,
yeah,
exactly. All of those best practices. Yeah.
Right.
Right now we're just kind of looking at how do you actually think about it, right?
Yeah.
So now for the sale part, so for sale we're gonna have 3 scenarios as well because of the tenant 2 situation.
Right. Okay.
And so right now, so we're selling it in the last year. So I'm going to assume that it's actually sold at the end of that last year. So, but basically all these numbers are just cumulative. It's happening in that year, right? This then, what I'm doing is I'm taking the, which is something to, hold on.
You're taking the NOI, right? And dividing it by
Yeah. I'm taking the NOI and dividing it by the cap rate. But so here's the thing, right here, I'm initially as we're modeling it, it's just a placeholder. I put it here so that I need it because I don't have the NOI yet. What I have is just the rents. We didn't do the expenses yet, right?
Right.
Yeah. So I put a placeholder here at that time, and then we do the expenses. Right. And then here, I think for the expenses, we made a simple assumption. Let's assume 30% for all expenses, just a lump sum up. Now, when you're running an analysis, usually you want to break out your expenses, especially if you, it's for a more complicated project that has operations or, you want to break it out because you're likely to have benchmarks that you can benchmark the different components of the expenses against. So, for instance, hey, we're looking at this. The current landlord or owner is not doing a really good job on these line items. So that's where we can come in and we can shave 20% off those or you know what, they had a great deal on something, but it's not very professional. The management company, they were managing it themselves. We're going to have a manager, so we're going to add a new line item, right? that's where you want to break it out. But for our case here, we're just going to lump it all in. We're not going to go into that much detail yet. And then what we're doing is it's 30%. So again, this is bad practice, 30%. Right. You see that?
Yeah. Right? You're hard coding.
I'm hard coding here for simplicity because I'm not making it a changeable variable or something. Mm-hmm. Yeah. But what we could do if we wanted to do it is we say, all right, you know what? Let's do operating expense. And then we're going to do 30%. Right. And I'll just put a variable there. Yep. And then what we can do then is
reference it.
Reference that.
Yep.
So here, and now there's a faster way to do it too, because here I have it all at 0.3. Mm-hmm. So what I do is I can select this whole thing. Mm-hmm. And then you do something called under edit. Mm-hmm. And it's called replace.
Oh, okay.
Yeah. So then I'll just say replace the times point. Hold on, let me see. I forgot if I put 0.3 or 0.3. Oh, 0.3. Okay. So yeah. So I go edit, replace. So I select only that section. What I'm gonna replace is the times 0.3 with an absolute reference to this 30%, which is I-14, right?
Right.
So I'm going to just go I-14.
Do you have to put the times? The times?
Oh, yeah, I do. I do.
Yep.
So then...
Place one. I guess you have to write out the whole formula, huh?
Yeah, I guess I got to write out the hard. You know what? That didn't work. Ignore. Scratch. We'll just do it this way.
Yeah. While you're doing that, in terms of operating expenses, one thing I'll often see is the in terms of the deals that we're looking at is the maintenance expense is often something that you want to really take a look at, because a lot of the sometimes the deals that you're purchasing are being self-managed, and people won't credit themselves with the labor charge. And so if you're coming to buy a property, if you're buying something, obviously not something as big as this, but something smaller, and you don't want to self-manage, and even if you do self-manage, I mean, you should still think about what the labor charge would be objectively, because when you're trying to sell it later on to another party, they might not want to self-manage, and if you haven't included that charge for paying someone to manage the property or paying someone to actually come in and fix things up, then someone else isn't going to give you credit for that, and they're gonna expect more of a discount on the price. So just something to consider. That's usually one of the biggest swing variables I'll see, is that the person we're trying to buy from just has not really credited themselves with the proper costs for managing a property.
Yeah, now, that's a great point, Dan. Because if you don't do that, you're also inflating what your exit assumption is going to be.
Exactly, yeah. And someone else might not do that, depending on who you sell it to.
Cool. So all right. So now that I have the expenses here, what I then can calculate then is the net rents, or the NOI.
Yeah.
For the low, middle, and high scenario, right? And which is really going to be, now this formula looks a little complicated, but it really isn't. Right. Which I'll tell you is basically we are taking the rents up here in the three scenarios minus the expenses down here.
Yeah, that's it. Yeah.
Yeah, and that's all we're doing. So I have that. The first part is if you look at the formula, the first part is just the rents, and then the second part are the expenses.
Right.
Now, so here's another thing to be careful of. Okay, now why am I adding here? Because for me, I like to visually show that they're negative, they're outs. So visually, so I'm adding negatives, which is subtracting, right? So you got to make sure if you do have show it as negative, then you want to subtract it. Now there's different ways to do that. For me, I do that, and then I'll pick so right now the way it's formatted right now as a number is not very clear, right? So what I could do is I could format this where let me format the cells where
you have it turn a different color or something.
Yeah, exactly. I'll show it as a different color. Okay. So I'll show it like that, right?
Right.
So now I know it's a negative, you know.
Right.
But it's a preference. What you do want to do is to show it clearly. So you could just show it as red and but still keep it as a positive number. Then you subtract it. You just want to make sure you're consistent.
Right. Okay.
Yeah.
That makes sense. Yep.
So now once we have the NOI, I can go back and calculate the sale price, the exit price, right? And the exit price, when you have a cap rate, is just going to be the NOI divided by your cap rate. Okay.
Yep. And that should be 5 in the cap rate for
it should be 5. Yeah. So 5 and 5. Right now I have those things. I'll tell you why I put 3 in there later.
Okay.
Okay. So then what we have now is once we have all the cash flows in, we have all the cash flows out, right? And then so we can get a sense of the total cash flow situation in all 3 scenarios. Okay. And that's where we say, okay, at the purchase, we have, I'm just going to make this red. We have the purchase where it's an out.
Right.
It costs us $28 million, and then we're getting these rents in the first year all the way to the 10th year. The 10th year is bigger because we're getting the rent plus the plus the sale, right? See, it's rent plus the NOI, right? So you're getting that. And so we have these 3 scenarios here,
Right.
So now we have this. This is what we call the unleveraged cash flows.
Yeah.
Because there's no debt right now.
Right.
Okay. So the next thing is when we look at financing, are we taking on debt? In this case, we are looking at taking on some debt, right? So the debt will say, all right, you start usually what you want to do is you want to start with what is your principal, and then you look at your interest payments, and then you got to track your principal payback.
Right.
What are you paying back? So you can treat the loan as cash flow coming in, and then you can treat the interest payments and the paybacks as cash flow out.
Right.
Okay.
And you made it easy by making it interest only, so we didn't have to actually create an amortization table and figure out what the actual principal due is.
Exactly.
Yeah.
And that's something that we'll visit in a future case study.
Okay, good.
There's a lot of parts that basically each of these sections there's more to get into, right? So we're gonna do more of those as we build up the case scenarios. Now, so here we start with the principal. Well, it's at 70%, and again, you see the 7 hard coded because we're not changing that assumption right now. But if we wanted to make a change, we can just pull the 70% out the way we did these
operating expense. Yeah.
But I'm just going to leave it in here for now.
Okay.
And then the interest will be what is the principal times the loan interest rate. Right. And so I have a reference to the interest rate.
Okay. Right.
And because it's interest only, it's the same thing.
Right.
And then in the last year, we got to pay back the principal, which will be equal to what we owe.
Right.
Yeah. Okay. So then when we have that, what we do is then we take the unleveraged cash flows and we add in or combine it with the financing numbers to get the leveraged cash flows.
Right.
So then now, if you think about if it costs $28 million, but you're getting almost $20 million from a loan, then your cash flow out is less, right?
Right.
And that's exactly what we're looking at here. And we'll see that here. Then here's the net cash flows, the leverage cash flows, and what it looks like with the sale here and this year.
Okay. And so for because you already have the net cash flows unleveraged, all you have to do is just subtract out the interest payments from all the line 74, 75, 76.
Yeah.
Okay.
Yep.
Okay.
And I what I did was I didn't want to have a separate formula for the last year, so I set it up. When you structure your analysis analysis like this, I can just add in the principal payback here, even though there's nothing. So then I can just do the formulas here, and I can copy paste down here, and I know it will execute correctly in the last year.
Right.
So that's kind of like an efficient way to do the modeling.
Okay.
Because what you don't want is the reason why I still add it here instead of just doing separate formulas. You don't want formulas to be different for a given role.
Yeah.
So like if I have a role, I want the formulas to be exactly the same here.
Exactly.
Right? The only time it will be different will be like if you have a starting condition, right? That's okay. That's on the left. But everything behind it, I want to keep it the same. Yeah. Right. Because if it's different, man, you got to make a note of it.
Yeah.
And it's, what if you change something later, you forget that you have something different in the back, and
it becomes
very messy, very difficult to manage.
Right.
Yeah.
Right.
Yeah. And you can introduce errors that you just forgot.
Right. And also it's easy for someone else to check you because they don't have to kind of interpret what you were thinking. They just, hey, look, I know what's on the left and everything to the right of it is the same.
So then when we have that, now the next thing we would do after financing is if you have different parties to the investment. So if you got investors, maybe you're the project sponsor, the developer, and you're getting some carry interest. That's a whole different animal to model out.
Okay, so now you said the equity splits and all that stuff.
Yeah.
Okay.
So we don't have capital structure here because we're assuming a single investor, and so that's out there, right? Then that means we're done. We're looking at the results now, right? Okay. And now let's look at the results. Look at the IRR. Based on those assumptions that were given, it's pretty crappy deal.
Something's got to change.
Yep, pretty crappy deal, and actually the debt actually doesn't help in this case because the debt is more expensive than the return you're getting, right? So this is a deal in New York, so. Maybe my cap rate assumptions were wrong because there are deals that trade at like sub 3%.
Right.
So it's actually maybe it's reasonable to assume a 3% cap rate in this market, right?
Okay.
And now because of the way we set up the model, I can just put in 3% up there and see what it looks like down here.
Yeah.
Right. And same thing, loan interest, maybe like, all right, you know what? I can find, as investor here, maybe you find an international sovereignty fund that's willing to lend you at 3%.
You're right.
And now if you're able to get 3%, but and you're looking at a 3% cap rate as well, your returns look a lot more attractive.
Right.
And then you can do some testing where, well, you know what, I can get the loan, but I don't want to assume a 3% cap rate. I'm going to go back to 5%. And you still see like, that's not going to work. It's
a pass.
Right.
Yep.
Yeah, it becomes a pass for most people. Be a pass. Returns. So then what it does, what it allows you to do is, you know what, I'm gonna need to be able to be comfortable with these assumptions in order for the deal to make sense.
Right.
So that's part of the kind of playing with your assumptions and seeing what's reasonable, what you can expect to be able to achieve. Right. Or maybe something where you're like, hey, I don't know about 3%. It's 5%, but they were very inefficient with their operating expenses. Yeah. There's I can get it down to 15%.
Right.
And that's where. Then you can see, all right, well, where you're finding your value, where you're adding your value is in operating a more efficient, operation.
Yeah.
Then you can get your returns back from there, right? So that's what kind of testing looks like. Okay.
Right.
So that's it. This is the solution for the first one. And then once you're really comfortable and if you got to share it with someone, then you can go and format it and make it pretty.
Right. Okay. So like a couple of things that for realistic scenarios that you might want to add to make this to sort of match some real life scenarios might be if the loan was actually amortizing and then creating like an amortizing table, probably on the next tab. Have you ever encountered a situation where, you're very efficient? Let's say you're a big company, you have lots of resources, so you can operate at a 15%, but you know that someone coming in is probably going to be operating at a 30%. So I should probably change that exit assumption.
Yeah.
Like what I can sell at.
Absolutely.
What they're gonna be thinking that they could purchase at and stuff like that.
So the way you do that is which would be you take a look at the NOIs in your exit year.
Yeah.
And you just create some extra line items and say NOI for exit assumption.
Right.
And then you adjust those NOIs by adjust it up or down to what you want what you think the potential buyers are going to be looking at. Right. Then you base your sales on that adjusted NOI.
Okay. Yeah. Okay. So there's all different ways that you could play with it. And I think that the bottom line here, though, is this is the structure. This is how you kind of
it's
set
more
it
of a
up.
framework. Yeah, it's a framework.
And you could play around with it depending on your own particular scenarios.
Yeah. And the thing, I just got a couple more things real quick is, this is all on one page. It's because this is a simpler case study. As you do more complicated things, you're probably, you may want to separate your, them into multiple worksheets.
Mm-hmm. Right. Okay.
And we're going to see some of that in the later case study. So now one last comment. Why is this a 90% solution? If you guys notice here, the rent bumps are actually happening in the middle of the year. Now, it's not going to change the returns all that much. Here, I'm assuming basically the rent bumps happening at the beginning of the year.
Okay.
Now, I'll show how to do it next week. But for those of you that are curious, try to see if you can actually make these rents and rent figures reflective of the fact that they're bumping on those specific dates in the year. In the same model here.
Okay.
Right? So there's a little bit of more formula magic.
Yeah.
But it won't change it all that much, but it's just something to know, to be able to do it more accurately if you're doing it this way. So that's a challenge.
I can think about the hard coding way. I can't think about it where you can change the variable. I'll be interested to see what other people come up with too.
Yeah.
Yeah.
That one little thing like that will take maybe about 30 minutes to explain. Possibly. But yeah, that's a challenge for those of you that are interested in it. So, hope you guys enjoyed this first case study. We're going to keep building on the complexity as we look at more. And we thanks to many folks in the group, I have plenty of case studies. Yeah. I probably have enough for the next 2 years for us to go through. So we certainly won't be running. Now, I know this ran way over what we thought, but I think we had a great discussion.
Yeah, I thought it was very, very helpful. Okay, so we'll end it here, guys. And if you have any questions, just post them in the Facebook group.
Yep. Thanks, guys.
All right, bye-bye.